Are you seeking the most acceptable ways to secure your financial future? If yes, you've come to the right place. Investing is a long-term commitment. When putting money to work in markets, whether for retirement or to supplement your savings, it's better to set it and forget it. On the other hand, long-term investment is more complex than throwing money at the stock market. Long-term investments are assets that an individual or business intends to maintain for over 3 years. Examples are stocks, real estate, cash, and other items that facilitate long-term investments. Long-term investors incur considerable risks to reap massive rewards. Hi. It's Tommy here, and you are watching Better Me with Tommy. If you're interested in investing, better financial future, growing up and personal development, then make sure to subscribe to the channel, hit the notification icon to be notified of new videos, and hit the like button if you find this video helpful. In this video, I have covered what is considered long-term investing, the top successful considerations, such as critical strategies, tips, and benefits that will assist you in making a successful decision in long-term investing. So, what are you waiting for? Let's take a step forward to secure your financial future. Firstly, let's talk about the benefits of long-term investing. Long-term investing is likely to result in significant wealth generation in the long run. Many people rely on long-term investment returns to plan their financial future since they lack the skills necessary to engage in derivative markets. It may include dividend income from stock ownership and interest from fixed deposits. So its benefits consist of: 1. It takes less time. Long-term investment requires less time since investors do not need to regularly watch markets for modest swings. 2. Reduced transaction costs. Long-term investors are charged transaction fees less frequently than short-term investors. Many investors can let their earnings accumulate in bank accounts while delaying capital gains taxes. Taxes on capital gains are also levied lower than taxes on short-term profits. And here are top recommended successful strategies for long-term investment for you. 1. Current financial approach. The current income approach involves a variety of allocation selections targeted at selecting established businesses that produce above-average payouts while minimizing the risk of default, such as large-cap and blue-chip shares. It is best suited for investors seeking a stable and consistent approach. To choose eligible firms, investors should concentrate on the primary drivers of long-term shareholder returns. 2. Capital expansion strategy. The capital growth approach seeks to maximize the value of all securities in the portfolio over a 10-year or longer time horizon. Portfolios of this type may include stocks and bundled products, such as exchange-traded funds, ETFs, and mutual funds. Depending on an individual's risk tolerance, such a plan may comprise a broad mix of securities. 3. A well-balanced investment plan. The balanced investing approach seeks to balance risks and rewards by mixing portfolios' investments. Typically, equities and bonds make up equal portions of such a portfolio's holdings. This technique is best suited to investors with moderate risk tolerance. Riskier but higher-paying stocks, such as preference shares and equities in firms with low market capitalization and credit ratings, are not included. They are the aggressive capital growth component of balanced schemes. Best long-term investment tips to help you get a grasp on it. 1. Make a plan for your finances. Before investing for the long term, you must first determine how much money you have available to support. That entails having your financial house in order. Begin by inventorying your assets and obligations, developing a fair debt management strategy, and eventually determining how much you need to build an emergency fund. However, withdrawing cash from long-term assets prematurely undermines your goals, may cause you to sell at a loss. 2. Consider the expenses of investing. Investing expenses may cut into your returns while also feeding into your losses. There are 2 high costs to consider when investing: the expense ratio of the funds you invest in and any management fees advisors impose. Trading fees were often required in purchasing individual stocks, ETFs, or mutual funds, but these are far less prevalent. 3. Fees for financial advice. You may pay additional fees if you seek advice on financial and investing decisions. Financial advisors, who may provide in-depth guidance on various economic issues, frequently charge a yearly management fee, a percentage of the value of the assets you retain with them. This is between 1% and 2% every year. Moreover, robo-advisors, also interesting, mostly they are a less expensive choice. They charge 0% to 0.25% of the assets they manage for you, but they often provide a more restricted range of services and investment possibilities. However, investing for the long term is the most effective way to accumulate money, which can only be obtained via learning. And, if you find this video helpful, please do not forget to hit a like button, share to your friends, and leave us a comment. And see you real soon. Good luck.